Okay, Chapter 10, Lessons from Market History. Key concepts, skills, so forth. Know how to calculate return on investment. There are going to be multiple types presented. Hopefully, you've seen most of them. Know how to calculate standard deviation of an investment's return. Understand historical returns, risk on various types of investments. We all know some investments are riskier than others. We'll talk about that as we move forward. Understand the importance of the normal distribution. Understand the difference between arithmetic and geometric average returns, or we also call them geometric and arithmetic means. The average or mean means the same thing. So, chapter outline: returns, holding period returns, return statistics, average stock returns, risk-free returns, risk statistics, more on average returns, U.S. equity risk premium, and historical international perspectives, and then we're going to talk a little about the 2008 financial crisis. So first subject is dollar returns. So dollar returns, the sum of dividend income and capital gain of the investment. So that's your so we take the initial investment, and then we're going to compare that to we're going to add in the dividends, and we're going to compare that to the ending market value. So we sum up the dividend income and then take the change in the value of the asset, and then we divide that by the initial investment. So the dollar return, dividend income plus capital gain income. So the percentage return is a dollar return divided by the beginning market value. So we have the dividend component, and then we have the capital gains component. So there we go. So this dividend, but dividing by the beginning market value, dividend yield, and then the change in market value. So that's your capital gains yield. So this example. So suppose you bought 100 shares of XYZ company 1 year ago today at $45 per share. Over the last year, you received $27 in dividend, or 27 cents per share on the $100. At the end of the year, the stock sells for $48. How did you do? So most books do this differently than I would do it. If you're just calculating the return, all you need to do is to consider the share price and the dividend. So, for example, this would be 27 cents plus 48 minus 45 divided by 45. That would be your return. So, but the way the book does it, we're going to consider all the shares of stock. So you multiply that 45 times 100, you get 4,500. That's your initial investment. So and then the stock goes up to $48, which raises the price to $4,800. So your dollar gain is $327. So that's $27 in dividends, and then $300 in capital gains. So your percentage gain for the year was 7.3%, which you would get the same answer here. This would be 0.073 or 7.3%. So anyway, I just find it easier not to mess with the shares. Just an extra calculation. So again, the dollar gain is $327. So our initial investment was $4,500. We had a $300 capital gain. and a $27 dividend. So as a result, our percentage return was 7.3%. Holding period return. So holding period return is, think of it's the same calculation as the geometric return, but you don't annualize it. So it's 1 plus the return multiplied by 1 plus the next return, and so on down the line. So in this case, we've got an investment. We're talking about an investment over a 4-year period. Once we do that, we subtract 1, and that would give us our holding period return for that year. So example here, suppose your investment provides the following returns over the 4-year period. So 10%, a loss of 5%, gain of 20%, and a gain of 50%. So our formula. So we've got 1 plus R times 1 plus R times 1 plus R 4 times. So 1.1 is 1 plus the 10%. The 0.95 is 1 plus the negative 5%. 1.2 is 1 plus the 20%. 1.15 is 1 plus the 15%. Multiply those out, subtract 1, and you get 0.4421 or 44.21%. So that would be your holding period return. One of the things to note is sometimes textbooks will use different names and so forth. We've seen that already. But in this case, we're going to use holding period return to note basically the geometric return for some period of time. So historical returns. We'll start the next lecture with historical returns.